If you are not investing right now, there is a very high chance you think you are the problem. You tell yourself, I do not understand it. I am not good with numbers. I do not earn enough. It looks complicated. But what if the real problem is not you at all, but the way investing has been explained to you? For decades, the financial world has taken simple ideas and buried them under difficult language. Acronyms, charts, graphs, disclaimers, and phrases that sound like they belong in a legal office. People are not avoiding investing because they are careless. They are avoiding it because the system makes it feel intimidating. So today on LedgerWave Insights, we are stripping away the jargon, breaking down the confusion, and showing you what investing really is, and why millions of people around the world are not actually investing, even when they think they are. Let us start with the truth the industry rarely says out loud. 1. Investing is buying the future, not the present. Most people think investing is about finding something that is going up right now, a stock that is rising, a cryptocurrency booming, a property market surging. But real investing has nothing to do with today. Investing is about the future, the belief that something will be more valuable later than it is right now. When someone working in Berlin buys shares in a cybersecurity company, she is not buying because it is trending. She is buying because the world is becoming more digital, more vulnerable, and more dependent on cybersecurity. That is investing, looking forward, not reacting to what happens today. 2. Most people think they are investing, but they are reacting. Here is the uncomfortable truth. Most people who say, I am investing, are actually reacting. They buy when everyone else is excited. They sell when everyone else is scared. They follow whatever is trending. They copy what a friend or influencer said. They check prices every hour and panic over small dips. This is not investing. It is emotional trading. Example: someone in Birmingham sees a video saying, buy this electric vehicle stock now. They buy instantly, not because they understand the company, but because they fear missing out. Another person in Dublin sells their investments after a small dip, thinking a temporary drop is a sign of disaster. Both are reacting to emotion, not investing in value. Investing requires independence, not imitation. 3. Investing works in years, not days. This is one of the biggest truths people never hear. Investing works in years, not days. But people want results in days, not years. They check their investments constantly. They panic when the market drops for 2 weeks. They say, this isn't working, because the short-term movement looks scary. But short-term volatility means nothing. History shows that long-term investing, held through cycles of growth and dips, is how wealth is built. Someone who stays invested for 10, 15, or 20 years has historically had a high chance of positive returns, not because they picked perfect investments, but because they stayed invested long enough for long-term growth to do its job. Investing rewards patience, not speed. 4. The terminology that confuses people. Another reason people don't invest is because the terminology feels like a different language. So let us break down the 4 terms that confuse beginners the most, in simple, everyday language. 1. Stock/share. A stock is just a tiny piece of a company. If you own a share, you own part of that business. If the company grows, your slice becomes more valuable. 2. ETF. An ETF is a basket of many investments you buy in one go. Instead of picking one company, you buy hundreds automatically. 3. Index fund. An index fund simply follows the market. If the market rises, you rise. If it falls, you fall a little too. Simple, predictable, long-term. 4. Compounding. Compounding means your money earns money, and then that new money earns even more money. It snowballs over time. Once you understand these 4 terms, investing stops feeling like a foreign language and starts feeling possible. 5. People avoid investing because they expect it to be complicated. For decades, people believed investing is only for rich people, financial experts, people with advisors, people with high salaries. But investing is simple. You put money into something that grows in value over time. That is it. The industry made it complicated. The concept is simple. When people finally understand ownership, ETFs, diversification, and compounding, they realize something important. The problem was never their intelligence. It was the way investing was explained. 6. Most people don't invest because they fear losing money. This is real, and it is emotional. People avoid investing because they have heard stories of losses. But here is the truth. Market dips are temporary. Market growth is long-term. Every major fall in history has been followed by a recovery, and often new all-time highs. Short-term drops feel scary. Long-term charts tell a different story. People who invest consistently over long periods are often rewarded because they stayed calm when everyone else panicked. 7. People wait for the right time and never start. Another hidden reason people do not invest. They think they need to start big. I'll invest when I have 500 pounds extra. I'll invest when I get a pay rise. I'll invest when I understand everything. And so they wait. Months, years, decades. Here is the reality. Small, consistent amounts beat large, inconsistent amounts every time. 20 pounds monthly over years outperforms 300 pounds here and there. The power isn't the size of your contribution. The power is your consistency. Investing rewards the person who starts, not the person who waits. 8. People don't invest because they don't have a simple plan. When you have no plan, everything feels overwhelming. People jump between trends, random tips, different apps, and panic headlines. A simple plan removes 90% of the confusion. Step 1. Build an emergency fund. Step 2. Set up monthly automatic investing. Step 3. Choose a simple, diversified ETF or index fund. Step 4. Review only a few times a year. Step 5. Stay consistent regardless of noise. With a plan, investing feels calm and predictable. Without a plan, it feels chaotic. 9. The final reality. Investing is boring, but transformational. Here is the truth nobody tells you. Real investing is boring. It is not flashy, it is not dramatic, it does not create viral excitement. It looks like automatic monthly deposits, ignoring noise, staying invested during dips, choosing simple diversified funds, thinking in years, not days, letting compounding do the work. It does not feel exciting today, but it transforms your life years from now. Wealth is not built through hype, it is built through patience. The people who become financially secure are not the ones chasing excitement, but the ones doing simple things consistently for a long time. If you have ever felt like investing is confusing, or too advanced, or something you're not ready for, remember this. You do not need to be rich. You do not need to be perfect. You do not need to understand everything. You just need clarity and consistency. And that is what we give you here on LedgerWave Insights, a clear, simple way to understand money without jargon, without noise, and without confusion. If you want more videos that decode the world of money, make sure you subscribe and join us as we break down how real wealth is built in the real world.